Thank you. The employees of the City of Mount Pleasant, its elected officials, and many members of the public who responded to our request for solution have spent considerable time in the last 7 years making adjustments to budgets to respond to the state's reduction in funding caused by Michigan's economic recession. Except for a few increases in fees, the majority of all changes have been made on the expenditure side of the budget. It appears fairly certain the state will not reinstate its funding partnership with local governments. In fact, we all expect to lose additional revenue as the legislature decides how to handle personal property taxes for businesses. Progress has been made in increasing the tax base as a direct result of some creative incentives that have been put in place over the last few years to encourage economic development. But those changes are not enough yet to overcome the hundreds of thousands of dollars that have been lost. Early in 2012, the Commission determined that the 2013 budget should be built as a sustaining operating budget and that the time would be spent looking closely at the revenue side of the equation. Over the last several months, the Commission has received and discussed an independent study on the workability of an income tax. At the last public meeting, the Commission took input on the idea of an income tax versus a millage increase. At the end of that meeting, Commissioners asked the staff to prepare sample motions to help target tonight's discussion. Before you move into that debate, however, we'd like to take a moment and respond to some of the questions that were asked of us 2 weeks ago. Mrs. Ridley has a very brief overview of the questions that were raised.
Thank you. Many of these questions, I think those of you up on the dais will probably know the answers to and could probably answer them on my behalf. So many of these questions are probably more for our viewing audience, but we thought it important to answer the questions that were raised a couple weeks ago, not necessarily address the opinions that were stated. I've grouped them into two categories. The first section is related to the income tax itself, the millage rate, or the income tax feasibility study. The second section is there more so generated or more so focused around the general finance questions or specific city projects that we've embarked on. So that's how I've grouped it together. I'll be the first to admit on the income tax ones, we don't know every single implementation question that we've been asked over the last couple weeks. My phone has been ringing with a number of very specific questions about my circumstances, X, Y, and Z, what does that mean? We don't have all those details until the ordinance is drafted. What we're focusing on is the general revenue that can be generated, the flexibility you do or don't have under the law, and how it impacts general groups of people. But having said that, we'll answer as many of the specific questions as we can. One of the ones was, how do we define taxable income as far as what people are taxed on? It's defined in the state law and by the IRS, but in its most simplistic form, I would say you take your adjusted gross income from your federal tax return, deduct from it some specific incomes that would be excluded, such as pensions and Social Security, and if you looked at the calculator on our website, it shows you those income categories that are excluded. And then also there's exemptions in the ordinance for specific issues such as death, disability, and blindness. So that's in general how taxable income would be defined. We were asked whether students would have to pay the income tax. Yes, they would. It depends on what they pay, though, would be dependent on whether they call Mount Pleasant home or whether they're just here as a non-resident. Just like everybody else, if it's their home, they would pay the 1% on their income. If they're a non-resident, they would just pay 0.5% on what they earn in the city only. Many questions over the last 2 weeks which surprised me about why don't businesses have to pay the income tax? They do have to pay the income tax. And again, if the business is located in the city, they're at the 1% rate. If they're doing work in the city, it's at the 0.5% rate. But as far as how it's paid depends on how that business is structured, whether they're a corporation, an LLC, or a partnership, and how they do their taxes, basically. We were asked if any analysis had been done of different rates than the 1% and the 0.5% that could be shared, and how could people be assured those rates weren't going to go up over time. The analysis that was done by the consultant only did it at the 1% and then the 0.5%. We haven't done any other calculations. As far as it increasing over time, the state law sets a maximum of what the income tax rate can be, and the state law says it can be no more than 1% for residents, and the non-resident rate must be half of whatever the resident rate is. Now, if you looked at our feasibility study, there were some cities who have more than a 1% income tax rate, but that's because they were grandfathered in or had special exemptions under the law. Any new cities are capped at that 1% rate. Seemed to be some confusion about how we got to why we were talking about a millage decrease of 4.3 mills. You'll recall the income tax study projected that we would net $2.5 million in revenue if we implemented an income tax. We weren't looking at implementing it to generate that much revenue. So what the study showed is if we wanted to be revenue neutral and get the exact same amount of revenue, we could reduce the property tax millage rate by 5.8 mills. But all of the assumptions we've been working on to look at this and the impacts, we've looked at netting $600,000 in additional revenue, which is how you get to the 4.3 millage decrease. This one was asked at the public hearing, but pretty much answered at the public hearing is, does the millage increase only apply to my primary residence? No, that millage increase would apply to all taxable properties in the city of Mount Pleasant. There was a question about, doesn't the study show that the millage won't decrease until 2021, and won't we be operating in a deficit until then? There was a chart in the study that did a 10-year projection of what our revenues would be under a millage reduction and income tax scenario, and it did show a reduction in the millage rate in 2021, but that was a second reduction. The first reduction takes place in the first year of implementation, but that 10-year analysis was done to show the fact that because there is a phase-in of the income tax, that it would not generate enough in the first couple years, so we would have to borrow from ourselves internally or use some of the fund balance to make up the difference, and then we could pay that back over the later years when it was generating the full amount. So by 2021, we could do a further reduction if all those assumptions were true. And I got to tell you, I can't believe that all of them are true all the way through 2021, but it did show a further reduction in that year. One of the questions was, why wouldn't you put more or less into the city's revenue by changing the millage rate more or less? As you well know, we certainly could do that. We were just trying to hit a target of new revenue, and we came up with that $600,000 by looking at our current year shortage, which was $200,000. We looked at the fact that there was a desire to increase the capital improvement millage by another $0.5 mil, so that was $200,000. Our best guess about personal property at that time was a $100,000 loss in 2014, and then we rounded it up to $600,000. But certainly, as you well know, we could do more or less than that. That was just a scenario for people to work from. One of the questions was, haven't other cities who have done an income tax then increase their millage rate back up? I really don't know the answer to that, because the last city that implemented an income tax did it in 1994. So I'm not really sure what commitments they made or what their plans were about their millage rates back in the 1990s to be able to know whether they were able to, whether they in fact have re-increased their millage rate or not. We probably could go back and do all of that research, but since it was so long ago, we have not done that to know if other cities really have just inched their millage rate back up. One of the questions was, how many people will be hired in addition to the $250,000 to implement? As you well know, we haven't determined that yet. It depends on what contracting options are available. But the consultant's estimate of $250,000 for implementation included any projected staffing we would have. So his estimate was the full amount would be the $250,000. Are we allowed to include an expiration date on the income tax? Certainly in the ordinance you can do that. Is it possible to dedicate the income tax to a specific purpose? Yep, you can do that in the ordinance as well if you desire to. And then how much did we pay Municipal Analytics for the study, and why didn't we use CMU to do the analysis? We paid Municipal Analytics $17,550, and that was based on an RFP that we sent out to 11 consulting firms or accounting firms. And just as a point of reference, we also sent it out to the CMU Public Policy Center at that time. We only received 2 responses back when we sent that out last year, Municipal Analytics and an accounting firm, and Municipal Analytics was the low bid at that time, and so that's how we ended up with them. And then the question was, are we getting anything back from Municipal Analytics for the advertising they're doing on their website that they did work for us? No, we're not. It's been our experience that when consultants do work for you, they quite often quote you as one of their customers, so we're not getting anything for that. So that, in summary, is the income tax and millage rate questions that we had. So I'm going to spend just a couple minutes going over the more general questions, and I'm not going to bore you with my typical Municipal Finance 101 discussion or my buckets and how that all works. So I'm going to just touch on some of these to try to answer them, but as you well know, I'm not going to be able to do justice to these questions in just a couple minutes. One of the questions was, what % of our revenues are used for expenses? This is one of the charts from our budget that shows where we spend the money. 58% on public safety, 17% on community services and economic development, 14% finance, 6% legislative, and 5% public works. So that's one way to look at how we spend our money. Another way to look at it is 71% of it is on compensation. And then we have the other parts of the pie chart as well. And one of the questions asked was, can we break our expenses down between fixed and variable? And the speaker was saying, and your personnel costs should be variable. So this, I don't have it broken down in that way, but we certainly could do some kind of analysis to do that. But I would just submit to you that if you think personnel is a variable cost, it is if we're willing to vary our services as well. So if we want to lower personnel costs, we probably have to reduce our services and vice versa. One of the questions that came through was when they compare our expenses from the pre-recession, whenever that was, to current, hasn't the city actually been increasing our spending? This is difficult to do without a real in-depth analysis because there's so many one-time expenses that happen, primarily capital kinds of expenses. For instance, in this 2013 budget, we have $440,000 out of the $11.2 million that's being spent on parks and infrastructure. So if I go back 5 years ago, I'm sure there's a number like that in the budget, but I would have to dig through to find out exactly what it is to be able to compare apples to apples. But I did look at where we were 5 years ago. Some people say that's the pre-recession era. At that time, our approved budget was $11.9 million. This year, it's at $11.2 million. But again, I wouldn't go to the bank on that because there's one-time expenses in both of those. How are expenses decided? You well know the budget process. It starts with the city manager recommending a budget based on your vision statements. There's a public hearing, you have the debate, and then you approve it in December. So that's really how expenses are decided. Only 2 more slides, so we're at the end here. One of the questions was, how long will we continue to be paying for our Project 2000 economic development that we did on the southeast side of the city? We did buy that land back in 1989 when we started that economic development project, and we paid, I think, $2.5 million for that land. And so for a number of years, there was a millage rate that was on each individual's tax bill that was a millage that was assessed to pay back for that land. But that millage rate hasn't been on the tax bill since 2002, so it was paid off 11 years ago. We looked at what the taxes are being generated in that 300 acres that we purchased, and last year the city taxes that were generated was approximately $410,000, and the taxes for all units of government just for that 300 acres was over $1 million, and those are per year numbers of what they're generating. So I would submit to you that Project 2000 has been paid back and it's generating tax revenue for the city at this point in time. There was also some question about industrial park sales and what the city was selling industrial park land for. And I had a hard time tracking that one down because the last sale the city made of industrial land was back in 2005. And what I heard was a comparison of a recent sale, so I couldn't really track that down because it's been 8 years since we've done a sale of industrial land. There were also a number of questions about the State Home or the Mount Pleasant Center and what we paid for it and what our plans for it are. Again, as you well know, we paid $1 for it, plus we had to reimburse the state for some of their appraisal costs. So in reality, the checks we wrote were for just over $54,500 for that 300 acres. To date, we've sold the surplus equipment that was in some of those buildings and generated $250,000, and we're using that to maintain the grass, the snow, and the security at the site. As you well know, we're applying for grants for the demolition and the abatement of those buildings, and our long-term plan always has been to try to sell the land to generate taxes and/or jobs, but we also knew it was going to be a multi-year process, so we don't have anybody knocking on our door yet that's ready to buy that land from us at this point in time. So I think that covers the major questions I was able to capture while people were talking and as I watched the public hearing again and as we've answered the phones over the week. But if you have any other questions, I'll be glad to attempt to cover those.
Commissioner Ingles.
Thank you very much. That was very informative. Is this information going to be on the website?
Yeah, we can do that.
I think that would be great. Thank you.
Any other questions? Vice Mayor Tillman.
I just wanted to say, I think you captured that quite accurately.
Oh, thank you.
And I think your answers spoke to each one of the questions that I think that very thoroughly spoke to the questions that I heard 2 weeks ago. So thanks a lot, Nancy, for the extra work.
You're welcome.